Hello everyone and welcome back to the channel. Today we are tackling a topic that is on everyone's mind in Nigeria, the major tax overhaul coming into effect on January 1st, 2026. You've probably seen the headlines about the new tax reform acts, and I know it can sound a bit intimidating, but before you panic, let's get one thing straight. The goal isn't to hide your income, but to understand the new system and legally manage your tax bill. First, a quick reality check. Deliberately hiding your income or faking your tax returns is illegal. It can land you in serious trouble with penalties, fines, and even criminal charges. That's not the smart way to go. The good news is the government has built reliefs and exemptions into these reforms specifically to protect lower paid workers. So instead of trying to outsmart the system illegally, let's learn how to work with it. Informed compliance is your best strategy. So what's actually changing? Before you can plan, you need the facts. The new framework consolidates a bunch of old laws into the new Nigeria Tax Act. The biggest change for most of us is the update to personal income tax rules and a new progressive rate structure. This means how much tax you pay will depend more directly on how much you earn. Importantly, thresholds and exemptions have been adjusted. A key feature is a full exemption for the lowest earners up to a certain threshold. It is crucial to read the official guidance from the tax authorities and use the official calculators they provide once they are released. Don't rely on rumors. Now, let's get into the practical, lawful strategies you can use to reduce what you owe. These are general ideas that work for employees, freelancers, and small business owners alike. But remember, for advice tailored to your specific situation, it's always best to speak with a qualified tax advisor. First up, claim all lawful exemptions and reliefs. The reform includes a full tax exemption for low earners. We've heard figures around the 800,000 naira mark, but you must check the official guidance for the exact number. If your income is below this threshold, make sure your employer isn't mistakenly deducting tax from your salary. You should also claim any personal allowances you're entitled to when you file. Strategy number 2, maximize your retirement and pension contributions. Money you put into an approved pension scheme is usually tax deductible up to a certain limit. By increasing your contributions, you not only lower your taxable income for this year, but you're also building up your savings for the future. It's a win-win. Third, look into approved tax-efficient investments and savings. The government sometimes offers savings bonds or other investment instruments that get favorable tax treatment. These might allow you to defer tax or even offer exemptions on the interest you earn. Keep an eye out for these government-approved products and check the rules that apply to them. Our fourth strategy is a big one, especially for freelancers and business owners. Take advantage of all allowable deductions, keep every single receipt and formal record for your business expenses. This includes things like professional fees, approved charitable donations, and other specific costs that the law allows you to deduct. For the self-employed, properly documented expenses are your best friend because they directly reduce your taxable profit. Next, let's talk about timing and structuring your income. This is strategy number 5, where it's legal and possible. You can sometimes lower your tax bill for a specific year by timing when you receive income or when you pay for deductible expenses. For example, you might defer a non-essential payment to the next tax year or bring forward a deductible expense into the current year. Similarly, you can structure your pay between salary and legitimate benefits like a pension, but be careful, this must be genuine and not just a scheme to dodge tax. Strategy number 6 flows from this. Use legitimate allowances and benefits in kind. Employers can sometimes structure part of your compensation as non-taxable allowances or benefits that are permitted by law. For this to work, everything must be properly documented and follow the regulations set by the tax authorities. Number 7 is for all the employees out there. Check how your employer is handling your pay or pay as you earn tax. Make sure they are deducting the correct amount and sending it to the tax authority. If they deduct too little, you could face a compliance risk later. If they deduct too much, you can get it back, but it's a hassle. Always get your payslips and don't be afraid to ask your HR or payroll department for a breakdown. Strategy number 8 is crucial for my fellow entrepreneurs, sole traders, and freelancers. You must register with the correct tax authority, keep clean, organized accounts, claim all your allowable expenses, and file your tax returns on time. Staying compliant is the best way to reduce your risk of an audit and avoid nasty interest and penalties. Next up, strategy 9. Family level planning, but strictly within the law. In some situations, you can legitimately split income between legal taxpayers. For example, if family members are genuinely employed in your business or own a part of it, this can sometimes lower the overall family tax bill. The key words here are transparently and genuine economic substance. Avoid any arrangements that look like a sham. And finally, our 10th and perhaps most important strategy, get professional help early. Don't wait until you're in a complicated situation. A good tax lawyer, a chartered accountant, or a registered tax consultant can help you identify all the legitimate reliefs you're entitled to. They can create a compliant tax plan for you. Yes, they charge fees, but those fees often pay for themselves by lawfully reducing your tax exposure and giving you peace of mind. Okay, that's a lot of information, so let's break it down into a practical checklist. Here's what you can do this month. First, start reading the official FERS guidance and summaries of the new Nigeria Tax Act. Second, check if your annual income falls below the published exemption thresholds. If it does, make sure pay isn't being taken from your salary. Third, start gathering all your important documents, payslips, pension statements, receipts for deductible expenses, and proof of any investments. Fourth, if you're an employee, have a chat with your company's payroll officer about lawful ways to structure your pay. And finally, if you're self-employed, get registered, tidy up your bookkeeping, and get ready to file your returns using any new forms required by the 2025 Acts. To wrap this up, remember that compliance is your protection. These new laws are designed to widen the tax net but also to protect low-income earners, most credible. Analyses suggest that a large number of Nigerians will actually see their tax rates go down or be fully exempt. Trying to hide from the taxman is risky and just plain wrong. The smart, sensible path is to understand the system, use the reliefs it provides, and plan ahead. For specific, personalized advice on numbers, limits, and how the new tax bands affect your pay, please consult an accredited tax professional or check the official Nigeria Revenue Service resources. Thank you so much for watching. I hope this video has helped demystify the upcoming changes and empowered you to take control of your financial future. If you found this helpful, please give it a thumbs up, share it with your friends and colleagues, and don't forget to subscribe for more content like this. See you in the next related video on smart compliance and savings checklist for your accountant.